Beginning your investment adventure. While this may pose a challenge for some, we aim to simplify the process for you through this video. At its core, investing is about charting a course for your financial future and aligning your goals with the right investments. This involves understanding your risk tolerance and managing it over time. Once you've defined your goals and risk tolerance, you're ready to dive in. Whether you choose to go solo or seek the guidance of a financial planner, the following 7 steps outline key aspects to initiate your investing expedition that not every financial advisor will tell you. Number 1, define your investment goals. Before delving into investment options, ponder your overarching objectives. Are you looking for long-term growth or seeking income from your portfolio? Consider the purpose of your investment, whether it's for retirement, a house down payment, or another milestone. This clarity will help determine the level of risk you can afford and guide you in selecting the appropriate investment accounts. For instance, if retirement is your goal, tax-advantaged options like IRAs or 401ks may be suitable. However, it's essential not to funnel all your investment money into a 401k, as accessing it before a certain age may incur penalties. Moreover, avoid investing your emergency fund in a brokerage account, as quick access to funds is crucial during unforeseen circumstances. Additionally, selling investments during market downturns can result in losses, especially if you need cash urgently. Number 2, selecting investment vehicles. Following goal definition, the next step is choosing the right investment vehicles, also known as investment accounts. Multiple accounts can collaborate to achieve a common objective. If you prefer a hands-on approach to building your portfolio, consider a brokerage account. These accounts grant you the flexibility to buy and sell stocks, mutual funds, and ETFs. While they offer versatility, they lack the tax advantages associated with retirement accounts. Several financial firms, including Charles Schwab, Fidelity, Vanguard, and TD Ameritrade, provide brokerage accounts. Traditional brokerages offer diverse account types, such as IRAs or custodial accounts for minors, along with the option to consult with experts over the phone or in person. Alternatively, robo-advisors provide an automated approach, ideal for those with clear and straightforward investment goals. Robo-advisors offer benefits like lower fees compared to human financial advisors and automatic rebalancing. A note on beginning your investment. Opening a brokerage account and depositing money is just the starting point. The crucial final step is making an actual purchase. Number 3, determine your investment amount. While deciding on investment accounts, consider the amount of money you plan to invest in each type. Your investment goal, coupled with your time horizon, will influence the allocation of funds. The general guideline for retirement goals is to invest 15% of your income annually. This percentage accounts for any employer matches, such as a 5% match on a 10% contribution from you. If you find it challenging to set aside 15%, starting with a smaller percentage is perfectly fine. The key is to initiate the process and let your money grow over time. Contemplate how you want to invest your money. An often debated question is whether to invest all at once or in equal amounts over time, known as dollar cost averaging, DCA. Both methods have their pros and cons. For medium to long-term goals, dollar cost averaging is a valuable strategy, ensuring consistent investment toward your goal. It helps benefit from purchases at both higher and lower prices, with the short-term fluctuating of the market. It's not about timing the market, but at the time you are in the market that counts. While DCA can be effective, it has downsides. Historically, investing a lump sum at the beginning tends to yield higher returns, as opposed to spreading investments over time. Given that most individuals don't have substantial cash reserves, dollar cost averaging often becomes the default choice. However, it's crucial to jump in and not procrastinate, as waiting for the perfect moment can be counterproductive. If opting for a lump sum, continue to add to your investments regularly to provide more opportunities for portfolio growth. Number 4, assess your risk tolerance. Understanding your risk tolerance is pivotal. It indicates the level of risk you're willing to bear for potential higher returns. Assessing comfort with volatility is crucial. A risk tolerance questionnaire can help gauge this aspect by posing questions related to emotional reactions to losses and market fluctuations. It's vital to distinguish risk tolerance from risk capacity. While risk tolerance gauges emotional readiness for risk, risk capacity considers financial factors such as job stability, caretaking responsibilities, and the time available to reach your goal. Number 5, define your investor persona. Investing isn't a one-size-fits-all endeavor. Your risk tolerance and capacity, along with your goals and time horizon, determine the kind of investor you'll be. There are primarily 2 categories: short-term investing or trading, and long-term investing. Short-term investing, trading. The allure of short-term investing lies in the potential to replace current income with profits from buying and selling investments. However, it comes with challenges and risks, given the swift market movements and unforeseen events impacting short-term investments. Additionally, short-term profits are typically taxed at higher rates than long-term investments, where assets are held for more than a year. Short-term investing strategies include day trading and swing trading. Day trading involves entering and exiting investments within market hours. It's notoriously challenging and often yields unfavorable results, especially for new investors. Swing trading, investors following this approach aim to buy and sell investments after a few days or months, capitalizing on significant swings due to seasonal events or trading patterns. Long-term investing. On the opposite end of the spectrum, long-term investing provides the benefit of time for compounding interest and more room for error during market volatility. However, delaying investment efforts can make it challenging to catch up with goals. Several long-term investment strategies exist. Index investing. This method, popularized by firms like Vanguard, involves investing in entire market segments, such as the S&P 500 index. Investors typically assume less risk than those investing in individual stocks. Value investing. Advocated by Warren Buffett, this strategy seeks undervalued stocks. ESG investing. Focused on environmental, social, and governance factors, this approach considers a company's impact on nature, employee treatment, and governance policies. Dividend investing. Investors adopting this strategy purchase investments to generate a regular income stream through dividends. Before we move on to number 6, please, if this video bring you any value so far, may you kindly click like and subscribe to our channel. This will really help us a lot, and we owe it all to you. Thank you. Number 6, crafting your portfolio. The list of investments you can choose from. With your goals, risk assessment, investment amount, and investor persona in mind, it's time to build your portfolio. Adopting a goal-based investing approach involves creating separate portfolio buckets, each with a unique goal amount, time horizon, and risk tolerance. Begin by selecting the right account type for each goal. Whether it's a brokerage account or your IRA, once the accounts are in place, you can start picking your investments. Here's a list of common investments to consider. Stocks represent ownership in a company. Their value tends to rise if the company does well. Bonds, loans made to a company or government, promising repayment along with interest. Bonds offer a steady income stream but historically don't yield returns as high as stocks. Mutual funds, investments pooling funds from shareholders to invest in a collection of stocks and/or bonds. They provide diversification without the need to buy individual securities. ETFs, exchange-traded funds, similar to mutual funds, ETFs offer the same benefits with lower fees and increased trading opportunities. Number 7, monitor and rebalance. After making your investments, it's essential to keep an eye on them. Market fluctuations can cause your initial allocation to shift. For instance, if you aimed for a 70% stock and 30% bond allocation, market growth might shift it to 80% stocks and 20% bonds. This is known as portfolio drift and requires rebalancing to align with your target allocation. It's also crucial to approach your investments cautiously following market downturns, avoiding impulsive decisions that could lead to losses. Investing need not be overly complicated. It's wise to avoid speculative, panicked, or fear-driven decisions, as these emotions can result in significant losses and increased risk. For new investors, the key is to proceed at a steady pace and strive for consistency. When in doubt, consider low-cost diversified ETFs as an accessible way to begin your portfolio. Always refer to your investment goals as your guiding star, keeping both your emotions and your portfolio on the right track. Remember, investing is a gradual process that unfolds over time, not an overnight endeavor. As we conclude this exploration, it's crucial to recognize that investing is not a sprint, but a marathon. A gradual process unfolding over time. The key is to start, stay committed to your goals, and navigate the evolving financial landscape with a steady hand. With newfound knowledge and a strategic approach, you stand equipped to embark on the empowering journey of financial independence and wealth building through the avenues of investing. Thank you so much for making it this far. If you have another point that we are missing, please leave it in the comment below. We would love to hear from you. Thank you, and as always, stay blessed.